Good afternoon to all of our viewers from across the US. This is Robert Rayburn here at Life Pro Asset Management. It is April 8th of 2024. I'm certainly glad that everyone could join us, and I hope that everyone had a fantastic weekend. Now, as we venture here into the second week of April, we had a bit of a correction in stock market prices last week. Not unexpected. If you heard from our updates of prior weeks, market short term was overbought, right? And that was certainly a function of being in a bull market, but also those short term overbought conditions were a little bit extreme. And that's okay. During bull markets, you're going to get these short, sharp corrections that are painful. Fortunately, I think now we're recording this on Thursday, so we'll see what Friday brings. So I'm going to put that disclaimer ahead. But overall, I think the areas that we're positioned in within the market, we're able to withstand that pretty decently. Energy obviously remains a key overweight for us. And energy is an area of the market that has continued to act well despite any of the gyrations. Where we are seeing more pronounced weakness and breadth deteriorating has been within technology. And that's an area we remain underweight. So right now we're focused on value over growth. We're more in the cyclical components of the market, such as energy and the banks and emerging markets. Those are really where we're spending a lot of our time and efforts right now, and dividend paying stocks. So with no further ado, let's go ahead and get started this week. Now, the title of this week's presentation is How High Will Gas Prices Go? When I say gas prices, I don't mean natural gas. I mean that gasoline right there at the pump. I just had to fill up my car yesterday. Certainly a little bit more painful. And that makes us think a little bit about consumer discretionary stocks and how long in consumer discretionary do we really want to be as oil goes higher, as gasoline prices go higher, as share of wallet gets shifted into the commodity space relative to the consumer space. You will see that view reflected in the portfolios. So right now, market remains a little bit overbought still, despite some of the price correction that we saw last week. Breadth and momentum are strong, though, and I think that's the key. Yes, short, sharp drawbacks, short, sharp punches to the face if you're an investor, but that breadth and momentum factor is strong. And so that's very emblematic of a bull market where short term you can get these pullbacks because things get overbought and people are a little bit overextended on their skis. But underneath the hood of the market, more and more stocks are getting dragged into the rally. More and more cash that's on the sidelines is getting swept into the market. And so that keeps the momentum strong, and that keeps breadth from contracting and actually pushes it outward in terms of expansion. And we're seeing momentum start to accelerate across value. And that's really, again, we believe we're in a multi-year bull market for value stocks, both on an absolute basis and relative to growth. We look at breadth. Now, this chart is a couple of days old, mind you, from when we're recording versus where you're probably experiencing the market as you're watching this. So be mindful of that. But the percentage of stocks above the 200-day moving average, right around 86%. You should not gauge this chart like a technical chart in the sense of, hey, this looks really overbought. When you have stocks when stock market breadth is this wide at 86%, tends to happen during bull markets, right? It's a sign of health. And you can see here, going back to 2021 and earlier, if we extended that back, you can have a very prolonged period where it stays at elevated levels. That's just a sign of a healthy bull market. That said, you can have short-term corrections, right? Even during bull markets, you can have on average 1 to 2 stock market corrections of 10% plus per year. I think it's important to remember that, right? So go back to our blueprint here. In a bull market, if we're overbought, and it's being backed by rising and strong breadth. If we get a correction in price, we want to use dips to add exposure. In a bear market, if a market is overbought, but it's in the backdrop of declining or weak breadth, we want to use rallies to reduce exposure, right? Now, a sign of a really healthy bull market is as one sector heats up and becomes overbought and starts to pull back, other sectors pick up the torch, right? So right now, where are we pessimistic on? We're pessimistic in technology. We think the sector looks tired. Its score is tired from a technical and fundamental and valuation perspective. That said, other areas are accelerating, such as industrials and the banks and energy and copper and gold. Those areas are accelerating. So you can have the market continue to do well because the torch is being carried from one sector to another. And at some point, that baton will be passed back to tech, and we'll be ready for it. So we want to, that's the way a healthy bull market acts versus everything goes up together and then crashes back down together. That we want to be careful when that kind of dynamic starts to take hold. We look at here at the Q1 scoreboard. So at the end of Q1, energy was the leader in terms of sectors, up 12.5%, followed by industrials at 10.7%, financials at 9.5%, and materials at 8%. It's a good little cocktail story to tell people, because guarantee you at that party, if you ask the average person in America what's been driving stock market performance over the last 3 months, they're going to tell you technology and artificial intelligence. And that, of course, would be false. Because outside of NVIDIA, your average technology stock has really struggled, and you see it in the performance there. You know, tech is the 5th best performing sector. Very confident. I am not uncertain that if you strip out the impact of NVIDIA, that sector performance is even worse. So again, something to be mindful of here is that if you look at the top ranking sectors in Q1, that is a market that is telling you value is coming to the surface and growth is taking a back seat. When you get strong Q1 performance in the S&P 500, tends to be followed historically, not guaranteed, by strong performance from Q2 through to the end of the year. Does that mean there won't be corrections like last week? Of course not. But structurally speaking, tends to happen during bull markets, and bull markets tend to deliver pretty good and healthy performance. And you can see that here on the historical chart. The other area that has also started to heat up, right? So when we think of a good economy, we think of people are consuming more energy. And we look at small caps, right? Small caps tend to be very cyclical. And why? Because small caps are composed of industrials, and they're composed of regional banks, and they're composed of small consumer stocks. So stuff that is very cyclical by its very nature. So under the hood, small caps are reaccelerating. We pair that up with value outperformance, and we pair that up with what the banks are doing. It really lends to this idea of economic cyclicality, and those are the areas that are acting well versus the areas that are struggling, such as tech, which tend to be more what we call secular growth. So for us, that playbook is value over growth. We look at 2 charts here. We look at large cap growth relative to value and small cap growth relative to value. We can see here the Russell 2000. This is your smaller cap stocks divided between growth and value. Growth really looks like it's trying to top out here. And so when this line goes down, that means value is outperforming. And we can see that even with the large cap space as well, that value across both small cap and large cap stocks is trying to take hold here. We're in the nascent stages of it, but we think that it's very much in the early innings of a multi-year shift. So when we think of that turn toward value, the 2 sectors that come to mind, energy and banks. Let's look at these charts. Energy, we have that ascending triangle consolidation. And again, we've seen a clear breakout out of that consolidation. From a technical standpoint, that does lend to a much more aggressive upside breakout. Again, none of this is guaranteed. We're just looking at the charts. We're looking at the technicals. When you see that type of consolidation and breakout to the upside, you usually can get a check back to test out the breakout before resuming higher. But that's a beautiful looking chart. When we look at the valuations, those look absolutely beautiful. So that is something we just absolutely love to see. Good valuations, very, very, very attractive charts. Those are things that we just love to see for a sector that we're invested in. Same thing with banks. Beautiful and gorgeous cup and handle right here, breakout to that upside. And again, relative to the S&P 500, we're seeing that breakout again. So two value sectors that from a chart perspective look great, and both line up for our valuation framework as well. And when we look short term, energy in terms of that momentum factor, percentage of stocks at 3-month highs at 83%. So you're seeing breadth expand across energy, and that's being backed by strong momentum. There is an urgency to buy these stocks at the breakout point. So you're getting not just participation at the stock level increasing, but you're getting participation at the investor level that is starting to increase. So strong momentum, percentage of stocks 3-month high, 83%. So strong momentum plus strong breadth does increase the odds historically of that rally durability. And the thing we love the most is that the crowd hasn't noticed. So if we look at the energy equal weight relative to the S&P 500, that's turned higher. And the overall level of investor fund flows into energy remains negative, as you can see here with this red line. When energy stalled out about a year and a half ago, you saw a healthy amount, 22 billion or so of investor inflows into energy. Right now, that's a 10 billion outflow. So you're getting a breakout of energy in that rising wedge formation right as investor flows are still negative. So if we see that flip positive, that's really, you can see how that lines up with technical breakout. We haven't had investor flows kick in. What can really push that higher? Well, fund flows go from negative to positive. Classic Gretzky moment here where we want to skate to where the puck is going versus trying to chase the puck around the arena. So again, really do love the setup for energy here. Even a short-term oil might be a little bit overbought. On the growth side, using this chart again, we can see here AMD, ServiceNow, Intuit, just classic examples of flagship growth names that are really struggling here to not just make new highs, but not break down. And they're starting to break down. And we've seen breakdowns with Tesla. We've seen breakdowns with Apple. We've seen NVIDIA start to stall out here at the $900 level. So across the board, we're seeing that flagship growth space really starting to struggle. And we want to keep an eye on that and not try to chase these names. Don't fight the tape. The market's trying to tell you something, right? The market's trying to say, hey, you know what? Got a lot of money into tech right now. Let's be patient. Let it pull back. And at some point, there might be a good entry point for these names. Don't act with religion on any sector, right? Price and volume is the ultimate determinant as to how we want to look at trying to get in or out of these sectors. Across the bond market, nothing really to keep us awake at night right now. No warning signs from credit. So whether we're looking at BBB corporate spreads, BB, CCC, so this would be your higher risk, high yield bonds. No real implied credit risk blowing out right now. So you want this line to be low. It implies low levels of credit risk. If this starts to turn higher, that implies rising levels of credit risk. We're just not seeing that right now. So that's really good news. So overall, value-powered growth in Q1, that's where we are positioned. We did benefit from that, and we expect that to continue. Will that continue every single day? No, right? I think was it on Thursday, we had a check back, but whether it's Friday or this coming week, we expect that the more pronounced trend between now and the end of the year will be value over growth. Strong momentum and breadth across energy that extends into the banks as well, emerging markets, China. We really love those areas. I think China is, I know it raises a lot of emotions with people, but when we look at one of the cheaper asset classes across the entire globe right now, you can buy really, really fantastic Chinese tech companies at single-digit PEs. We think that's one of the more attractive asset classes on the planet right now. We have been going shopping there. Lastly, credit markets appear strong and they do appear healthy. So that's what we got for you this week. 888-543-3776. Hope you have a fantastic week, and we'll talk to you again soon.